All right. Good morning, everybody. Good morning, market scholars. My name is David Settle. Glad to have you on board on Berkshire Hathaway Day, right? So yesterday was a Star Wars Day, and today is Berkshire Hathaway Day. Also happens to be El Cinco de Mayo. So a happy Cinco de Mayo to those of you out there celebrating today. For you Star Wars nerds, I saw something yesterday that said that if Friday is May the 4th, the Star Wars Day, and then we have Cinco de Mayo the next day, then yes, and it is the Kentucky Derby. That's right. I follow Andy Swan, and Andy Swan's a big Kentucky Derby guy. But yeah, so if May the 4th is on Friday, Cinco de Mayo the next day, then does that mean that the Sunday will be Revenge of the 6th? So if you any Star Wars nerds will understand that one. All right. Let's hit these disclosure slides. Remember that everything we talk about is for educational purposes only. Not intended for financial advice. I remember everyone takes personal responsibilities for any trade that they make, even if they are the same as the trade ideas or examples that we use in our classes. No guarantees. Risk of loss in trading can be substantial. Make sure you're considering all relevant risk factors, especially your own personal financial situation. And again, I'll remind you, when we look at these trades, when we put together these class portfolios, we are not considering your personal financial situation. That's what a fiduciary does, and Brandon and I are not fiduciaries. All right, so everybody's got their own responsibility, and that's in our terms of service there. Remember that past performance does not indicate future success. And again, that sounds pretty harsh about the personal financial situation, but there's hundreds of you that we'd have to consider before entering a trade, and that's just too much, right? Too much. All right, so with that being said, remember to, this is a Q&A session, so remember to put your questions in the Q&A window. We'll keep it limited to one at a time. I've got 3 in there right now, so we'll put in, start putting those onto my scratch pad here. And then Arthur's. Yes. Yeah, so you can add anything, Irene, any type of question. So here's some things here. Topics that come from my classes, right? Any topics that come from my classes, and anything that pertains to the platform, right, to like the Thinkorswim platform, and anything related to trades that you're making on your own. They might not be the examples in the classes. They might be trades that you just have on yourself. So Sunita had a question that she sent to me in the chat. Sunita, make sure you put that question in the Q&A. If there's a stock you're looking at or a stock you're in or something that's related, again, to what we talk about, then those are all the types of questions that can be covered. Okay. All right. I'll just throw that one from Ashford in there. And I'll just go down the list as we go. So like I said, it can be anything. I just can't cover Brandon stuff. All right. So that's the things I struggle with. The content, I'm obviously not nearly as well versed on like he is. So those are the kinds of questions I can't answer. But anything technical analysis related, anything options related, anything portfolio management related, anything questions on macro, any questions on the macro environment, any questions on market posture, any questions, like I said, on trades, all those things. not we've kind of made. I mean, we've kind of, as of right now. Oh, okay. So uploading a spreadsheet on the. Okay, I'm gonna throw that on. And remember to use the chat window to interact back and forth, and use the Q&A window to just put your questions in. Put your questions in there. All right. All right. So that being said, I'm just kind of making sure we got everything going. And let's hit the share my screen. And that will bring this over. And I need to get my chat window up. And there should be, for those of you who are new to this, there should be a Q&A panel somewhere in that toolbar at the top right corner you should be able to find. That's a good question. There are a lot of good questions in the Q&A so far. So here's my notepad. You can see it here. Get rid of that tab. That's what I've got so far. So we'll start off by talking about Berkshire Hathaway, the company in question today. Berkshire Hathaway looks, this is from Eva here, and again, so Sunita, okay, so got it, got your question there. All right, so Berkshire Hathaway is going to look very, I mean, it is a, it's kind of like a proxy. It's a, you know, large cap, has a lot of large cap companies. It looks very, it's going to look very similar to what the market is doing. You can see if I look at the broad market itself, I mean, you look at those two charts, and you can see they're very darn similar to each other. Okay, which means that, you know, Berkshire's also got some support in this area, about 191.5, and you know, now it's kind of closed back up above. It's hit that low point, traded around that low point again, and formed a nice, good bullish candle here. Right, a good bullish candle, closing above the high of yesterday, closing above the high of the last few days, like some of these other major indexes have. Its momentum line spiking to a reversal zone, which you typically don't get when you have clusters. You typically don't get that, and we talked about that in yesterday's technical analysis class. When things are so bearish, it's hard to get bullish enough to get a cluster or get an extreme on the. I'll move this back over. It's hard enough to get an extreme on the momentum line, because again, the momentum line, to get an extreme on the momentum line, it's got to be a bigger than normal range, which when you're getting, you know, oversold clusters, you're typically getting some big candles, so it's hard to get a bigger than that candle. And then the other aspect is you have to open low, close high, and close right at the high. And so, like I said, it's, you know, not too bad when you're not, see, we didn't get any clusters here and we didn't get any clusters on the broad market either during this pullback. You can see, you know, as bearish as we've been, you know, this is kind of another aspect here, another aspect of this market that we're in. As bearish as we've been, look at the intermediate. I mean, because, I mean, I've had so many people tell me, you know, is this it? Are we breaking down now? Is this starting that bear market that we haven't had for a long time? And, you know, a lot of people called that a bear market, even though, you know, if we would have had a 20% decline from that high that fast, I would not have called it a bear market. In fact, that would have been the buying opportunity for the ages. Because bear markets are bearish trends. They're not just like a few week tank. You know, they're just bearish trends, and we didn't get any bearish. You know, This is more of a bearish trend right now, and obviously we're not down 20%. We're not breaking support. So, excuse me. So I've had a lot of people ask me, mostly people that are not market scholars, because you guys know. But a lot of people, like on Twitter, on YouTube, ask me, is this it? Is this the bear move? And again, look at the intermediate line. I mean, yeah, market sentiment's below 50. We haven't had market sentiment below 50 for a very, very long time. If I were to go out a few years here. That's the orange line, right? So last time we had market sentiment below 50 was right before the election. You know, we were down. We were kind of like we are right now, but a lot tighter in the range, right? A lot tighter in the range. Had a false breakout. Remember how bullish false support breakouts are. You had a false breakout on the election, and then right before the election, and then bam. And again, false breakouts are very, you can see where my cursor is to the right of my cursor. False breakouts are very bullish. You know, if we break down below support, which we did right before the election, we broke support, some pretty major support. You can see my line. Look at all those touches around my line all the way to the left. So we had some pretty major support over there. We broke down and then came right after the day after the election, came right back up. Okay, that's the last time we had, excuse me, market sentiment below 50, and you can see what the intermediate line did. So we did get a cluster down there, multiple clusters here. You see too, before that was late 2015, 2016 was the last time you had the orange line below 50, the dotted orange line. Look how long the intermediate line stayed in the reversals. In fact, you got, you know, a couple really strong, excuse me, bullish divergences on that. Okay, now compared to now, compare it to now. I mean, yeah, that looks frightening. That looks very frightening, and you'll see it on Berkshire too. Oops. You'll see it on Berkshire too, right? It looks very frightening, but you know, and there's, you know, here's Berkshire. So it had a little bit more of a bearish run there, and then here's the late 2000, right before the election. What happened with this company right before the election? So it had more of an intermediate, a bearish posture, and there's your market sentiment. And then there's late 2015, late 2016, and what the intermediate line did there, right? So go back to SPX. So you can see, you know, the intermediate line dipped there to 19.7 on the biggest drop that we've had in a long time. It brought the intermediate, and that's why, like, again, buying opportunity, because it brought the intermediate line below 20 for a day, and it like dipped its toe in the water for a day. That's how bearish we were. And then, lo and behold, we were bearish again and touching that 2600 level again, and it brought the intermediate line down for another day, one day below 20. It got to a whopping 16.5 where my cursor is. So with all that being said, you know, and there's a reason why I'm talking about the market here too, because Berkshire, as you saw, follows the market. Right? Follows the market pretty darn closely. But I mean, this kind of just shows, you know, as frightening as that looks, and as much as we have pulled back from that 2872 high, I mean, we are just not that bearish at all, according to the intermediate line where it's at. Right, according to the intermediate line where it's at. So yeah, so you know, the question is on, you know, what do we look at? Is there opportunity in Berkshire? And the answer to that, to me, is yes, because you know, I think there's opportunity here, just like there is in the market, right? Just like there is in the stock market as a whole, because this company looks very similar to SPX. And if SPX takes off, so will Berkshire. So will Berkshire Hathaway. And right now, actually, Berkshire is more bearish than the broad market as a whole, because remember, the S&P's intermediate line has already turned up about 50, and Berkshire is still in the lower reversal zone. You know, it spent a whopping, let's see here, 1, 2, and now 3 days, and forming a little bit of a morning star candlestick pattern, however you want to look at that there. Okay. There's a question here about what do these lines represent. So the pink line represents a bearish posture. The darker pink line represents a bearish posture with the intermediate line falling, and it's below 50. A light pink line is a bearish posture with the intermediate line above 50. The dark green line is a bullish posture with the intermediate line above 50. The light green line is a bullish posture with the intermediate line below 50. Okay, so that's what the different colors, and of course the colors on the moving average up here is where the price of the stock relates to the moving average. So if the moving average is falling and you're below the price, then it's going to be red. If it's falling and you're above the price, above the moving average, above the line, then it's going to be yellow. Right? If it's rising and you're above the line, it's green. If it's rising and you're below the line, it's going to be yellow. Okay, so that's what that's what this line up here represents. So, I mean, right now Berkshire is still below its 6-week moving average. So it's still, even with the nice little run it had on Friday, with almost 2 times the ATR on Friday that you had there. Let's look at one more chart for it here. There we go. Let me zoom out a little bit on this. All right, so again, we have 3 red arrows right now, and that's usually not the best time to buy. And so yeah, we did get a close above the high of the low day. There might be an opportunity here to build into a position, but you can see the MACD and the stochastics are both still red. If you take a look at them on a 2-line basis here, you can see that the price did get above all these lines. Excuse me, that's SPY. The price did get above the 8-day moving average, still below the 30, and you can see the 8 still below the 17. So that's why you have. See, I got your question, Ralph. It's on my notepad down here. So the 8 still below 17. That's why the MACD is still below 0. See, the blue line is the actual MACD line, which measures the gap between this 8 and the 17-day line. That's what the blue line measures. So the histogram's not giving you a red arrow yet because the MACD is not above its moving average yet. But you notice, here, let me zoom out. You notice, does anything stand out to you about these, about the MACD and the Berkshire itself? Anything stand out to you there about the price and with the MACD? Yeah, divergence, isn't there, Irene? Exactly. Everybody see the divergence there? I only had one response. Does everybody see the divergence? Now, do you see how the divergence works? Because if you see look at the lines and how they converge and diverge. So, Michael, the divergence is when you're trending lower. So you see how these lines are trending lower, and you actually got slightly lower lows here. But when the lines are trending lower, you would expect the indicator itself to trend lower too. Okay, but it didn't. So we didn't get a lower low on the MACD. We got a higher low on the MACD. And so that's when you get a higher low. See, the MACD will tell you. The MACD tells you that, here, let me, one second. All right, the MACD tells you that, see how you have, you know, it's going up to higher lows, that we would have, you know, that we'd be up here somewhere with the price. And so, I mean, it's not a huge divergence. It's only slightly lower lows, but see that gap, the MACD says is too much, that we've gone down too low. So it's not the biggest divergence, but the idea is you've got a downward trend, lower highs, lower lows. The question is, when is that trend going to end? So the indicator should also be giving you lower highs, but lower lows, and we're not getting that. And especially, in fact, we're actually getting higher lows. And if you look at these, annotations, if you look at, these divergences, so now you can see how divergences work. Why did I get a higher low on the MACD? Right. Well, it's because look at the divergence here. We had a nice, good divergence away from the moving averages on this drop. So now we got a new drop in price. Oops. So now we got a new drop in price here. But look at compare the divergences to a lower low. We got a new drop to a lower low. But look at the divergences. It's a lot smaller between the lines, between the blue, red, and green lines. You see how the divergence, the gaps between the lines, is a lot smaller than it was on this one. So that's why you get the higher low point. Even though I did go, it's a new low, it's a new move to the downside, right? So here is one move to the downside. Here is two moves to the downside. But the second move to the downside wasn't nearly as strong as the first move. And how do I know it wasn't nearly as strong? Because the lines didn't diverge very much. And so, and how do I know they didn't diverge very much? Because I got a higher low on the MACD. And that's how divergences work. So, when you are trending higher, here, so now let me get rid of my annotations. Let me go out a little bit further. When you're trending higher, like you are right here, you can see that each new high, each new bullish move gets you to a bullish peak, right? And every bullish peak, until we got to this one here, was higher, right? So there's a little bit of divergence on that one. It didn't play out too much. In fact, you can even see one right here. The lower highs in the MACD right there, the blue line, the lower highs in the MACD. But if you look at the corresponding highs, they were higher here. So a bearish divergence that led to all that weakness that we had on Berkshire in November 17. Then you notice we went up to higher highs, higher highs, higher highs, higher highs. We never did get a divergence here. That signified the trend, the end of the trend. You notice here's the divergence, bearish divergence on that move in November coming off of the elections, right? That led to that extended bearish run right there. And even a bigger divergence here because we had a new bullish move, a new MACD peak that was even lower than that one, even though the price got to a higher high. It led to another period of weakness in the stock. Because a divergence says that, it's gone too much. It's gone too much. So now you can see we're getting progressively higher lows in the MACD, which means we're getting progressively smaller divergences on these moving averages. That would tell me it's a reversal sign that we can break up to the upside. Okay? That's a reversal sign that we can break up to the upside. Okay, so the question is, what is the significance of divergences? The significance of divergences is they tell us, they help us know, and you can see another one back here, higher highs with lower highs on the MACD. They help us know when a trend may be ending. Of course, nothing's 100%, but they help us know when the trend may be ending. Right now, we're on a bearish trend. The lines are pointed down. And we're getting multiple instances of divergences on these lines to the downside. The question is, when is it going to be the last time that we get a divergence to the downside? Well, as of right now, the MACD, and for that matter, the stochastics a little bit too, it's telling you that this could be the last. This small little divergence that we had on the moving averages after converging here, this small little divergence could be the last one to the downside. And that's what the pattern's telling you. So could you trade that? Yes, but again, the trend is down. You know, we're below a downward trending moving average. There's a lot of other indicators, you know, looking at the market forecast. You saw the market forecast for it. Whoops. You know, you saw the market forecast for it. It's still below 90. Still below 90 there. So, you know, if you are going to trade that close above the high of the low day the last 3 days, if you are going to trade this spike in the momentum line up above 90, which is a canary in the coal mine for a posture change, you know, and we're not quite there yet because we haven't got above 20. If you're going to trade the fact that, you know, there's that possibility of a divergence, then you would do it with a very small position to start off. You would do it with a very, very small position to start off. And then build into a position as you get more confirmation. Because technically, divergences lead to trend changes too, right? So let's go back to the last chart here. Divergences lead to trend changes. How do you know when I'm getting the trend change that it's pointing to? How do I know? Well, again, here's the 2 lows that are diverging on the MACD. There's this divergence and this divergence. That's what's producing, you know, the divergence on the moving averages. You know, these 2 divergences on the moving averages are what's producing this higher low, this set of higher lows on the MACD itself, right? So you notice the peak in between. See, there's the MACD peak in between, where the 2 lines, where all these lines converged, you know, towards each other. So there's a peak in between. That peak right there, 201.25. We're about 200 because you got that low point here. You've got a couple of touches in this area, and you've got, you know, you've got some. Before we got this fluffy move on the markets in the beginning of 2017, you can see we're kind of stalled here at 200. Big round number can typically act as a resistance level. So right around that 200 area, you're going to have to close above that 200 area because of the divergence before you really get confirmation of a trend change. Okay. That's when you can say, okay, I can start to build into more of a position. I can start small now with whatever signal, you know, the close above the high of the low day and intermediate line eventually turning up and the MACD diverging and turning up above this moving average. You can build a small position and be speculative with a small trade risk because your stop order would be down here below. And this kind of goes with, there's a question about stop order, so I'm going to answer it at the same time from Arthur. Arthur, your question about, do you put your stop order below support? How do you select the ATR to use below support area? Is it just ATR below the low? And the answer to that is yes. If I were, you know, if I were in a very small position right now, I'm banking on this to hold to be the beginnings of a trend change, then this would be the low point. That would be my support, right? It's not very strong support because it is a lower low, but it is a support. And I put my stop order below that, and I would put it at 1 ATR below that. ATR right now is at 3.63. Yeah, 3.63 here. I wonder why it's showing 3.45. Maybe because it was the day before. Yeah, it was the day before. Okay, so yeah, so this is showing today's range versus the prior day's ATR. So 6 versus 3.45. So right now it says 3.63. So if I were banking on a move today, buying this on this candle, then I'd put it at 3.63 points below 189.80, which is the low point on this day. Top left corner where you see the open, high, low, close numbers. The L is the low, obviously, and so I put my stop order 3.63 points below 189.80. So that would give me a trade risk $189.80 minus 3.63 minus 195.64. That would give me a trade risk right now of $9.47. That's my trade risk. And that happens to be about a 5% drop. So in other words, I'd be willing to let the share price drop 5%. I'd be willing to let it drop. Now it rose 2% today, or Friday, yesterday. So I'd be willing to let the share price drop almost 5% before I got stopped out. Okay, now if we get above 200, let's say we close up here at about 202.25, and you're like, woo, yes, I've got more confirmation that the divergence is playing out. By then, you're most likely going to get the stochastics above 50. You're probably going to get the intermediate line close to 50. You're probably, you're getting confirmation up there, a lot more confirmation. Well, now 202, and a half minus my stop order, which was it was 189.80 minus 363, 186.17 minus 202.5. Now my trade risk is $16. So that's the price I pay. Because now, again, remember, trade risk is the denominator in your position sizing formula. Your portfolio risk is your numerator. Your trade risk is the denominator. My denominator has almost doubled, which means I'm going to buy half the shares at 202.5 that I would right now. Okay, I would buy, but because I have more confirmation, I'd be willing to put on, a bigger portfolio risk than I would here. Here, I put on a really small portfolio risk because I don't have very much confirmation. But as I get more, I'd be willing to build into a bigger portfolio risk. No, I say bigger, I don't mean bigger than normal. I'd be willing to build up to a normal position size on this. If I haven't done anything yet, then I could do, say, for example, if your position size, your normal position size is 1%, and you haven't done, you're waiting for that divergence breakout, then once you get that breakout, then you can put on a full 1% position, right? Then you can put on the full 1% position. If you're doing a trade now, like say with a 0.25%, then as you get more confirmation, you can add until you get that confirmation, and then you can add that last block of shares that will get the whole thing up to a full 1% position size. Keep in mind, if I trade that breakout, what did I tell you about fake outs? What have I told you about fake outs? Like when you break out above a level and it doesn't hold. What have I told you about those breakouts? Fake outs, sorry. From a technical analysis perspective. They can be very bearish. Yeah, exactly, Curdy. Fake outs can be very bearish. So if I get the breakout above this 200 level and we close up above like 202.25, if I get that breakout there, maybe even up to like 203, and 3.63 points. If I get the breakout here, then I can put my stop order at an ATR below that old resistance level, knowing that if we break back down below that resistance, that's a fake out, and things will be really bearish for the stock. So I don't have to. If I get a move up to 203, for an example, and you think, oh, now I got to put my stop order down below that low point. No. Now you can put it below that old resistance. Not too close, right? Because you don't want it you don't want it to be whipped out within a normal day's range. So you put it at 1 ATR below that resistance. So that way, which would be, you know, right now almost 3.5 points below 200. That way, if it does fake out and break back down below that resistance, which would be very bearish for the stock, then you get out. That's when you get out. Yeah. All right. Sunita's asking, what are the stocks in Berkshire? No, that's what this whole weekend's all about right now with that Berkshire Hathaway event. So, you know, that's a good Google. If you just want to Google what stocks are in Berkshire, he's got obviously obviously Apple's the big one, at least this week, the big one in the news. That's why Apple, you know, it was announced on Friday that he had bought more shares of Apple, and that's why Apple took off. So this was one, but he doesn't own this company, obviously. He just owns some shares. There are some companies that he has bought under the umbrella of Berkshire Hathaway, and then there are shares of companies that he's made investments in. That's a good, I'm sure there's plenty of sites out there that would have that information. Yep. Yeah, Geico would be one that they own. They also, like Apple, he just has shares. He has an investment in Apple. He has some shares in that. And Apple really took off. 52-week highs today. Again, as bearish a market as we are in, right? As bearish a market as we are in, Apple's at a 52-week high. So consider that for a moment. Consider, you know, are we going to break below? Are we going to break below support? Are we going to break above resistance? So think about that for a minute. Are we going to break it below support? Or are we going to break above resistance? Well, consider Apple is at a 52-week high. So that's why, again, I mean, I could be very wrong, and it wouldn't be the first time. But I still expect us to break through that resistance line before we break through this support line. Now, I don't think we'll get up above 2,900 anytime soon. I think we'll find a lot of resistance in trading in this area that will muck things up for a bit. I do think we'll grind higher within this area before I think we break through support. I don't think we'll break through support anytime soon. Okay. All right. That's a nice, good discussion there on the market as a whole and Berkshire too. We've got these questions finished. All right. Is there any way I can kind of, no. All right. So we got those. So what makes a stock price tank after an earnings beats the estimate? Let's see, who did that question come in from? That came in from Marsha. Why do stocks tank when the earnings beat the estimates? Because let's see, the Tesla stock, did it tank after its earnings? I think it dropped a little bit, but not very much. Yeah, I did a little bit there. All right. Tesla was nice for me. A nice, good earnings trade on this one. Tesla finished right smack dab in the middle of a double calendar spread on earnings for that one. So good, good move for this stock. This stock, you know. So when you look at a double calendar for earnings, and there's a question, I think there's a question too about that. So I can hit these both at the same time because they're both kind of related here. How to set up a calendar spread to protect. So when you set up a calendar here from an earnings announcement, and I guess we'll talk about it from the perspective that you do not own a position. So I do not. Tesla had a really high volatility in this week's options heading into that earnings, expecting a big spike move. And you can see the moving averages have converged. You see how the MACD was getting back up towards zero, and right now it's pretty much at zero. So they're sitting right on top of each other. But some of you have seen me talk about doing a double calendar where you sell sell options outside of the current price. So one up here and one down here. So you kind of bracket the current price, and you're selling really, really expensive options that expire right or soon after the earnings announcement. So you get the volatility crush and the time decay, and those options pretty much are worthless from an extrinsic value. They get rid of all their extrinsic value. They might have intrinsic value if the stock makes a big move, but they lose all their extrinsic value, and that's what you're selling is the extrinsic value. And then you're protecting those trades, those short strikes, you're protecting those with long strikes that are further out. So when you look at Tesla, you know, you won't see it now because the options are expired. But this number was really, really high. In fact, you can actually see it on the think back here. This number was very, very high a few days ago. There, you can see that. So very high, and then back here it was very low. So you sell this really expensive options that have high volatility, and you buy to protect them down here where it's not so high, where the volatility is not so high, okay, where it's more normal. Now you see they fall down too. Watch these numbers over here to the right. You see that they fall down a little bit too, right? If I were to look at the June 15 at 62, June 15 at 54. So it dropped about 8 percentage points. But this May dropped from 124 to 50, and of course now it's at 0. You know, now it's at 0 because it's gone, right? It's completely wiped out. So yeah, so you can sell this stock, sell a call, sell a put that's really expensive and protect it with a long call and long put. Well, if you think about those two trades together or separately, one is a short strangle that's really expensive. It's got a wide, it's almost like an iron condor. You know, it's a short strangle that's expiring worthless, hopefully, right? If the price of the stock stays, and you can see Tesla pretty much did stay after the earnings. A little bit of a drop and jumped up yesterday, and pretty much is right smack dab of where that short strangle was. So 100% gain on the short strangle for the options that expired this week. Then the second part of that trade is a long strangle, where you have the same strikes, but you have long calls and long puts. And what is the purpose of a long strangle? The purpose of a long strangle is you think the stock's going to make a big move, one way or the other. You don't know, but you're buying out of the money options because they're cheaper. You're buying out of the money options, but for you to break even at expiration, the stock has got to get outside of the strike prices. But again, you're expecting a big move. So that's what a long strangle is. And you know, the nice thing about a long strangle is stock can go either way, one way or the other. It doesn't matter. You got a call and a put. You bought a call and bought a put. The downside to a long strangle is you have twice the theta. You have double the theta. Right? That's the downside. It's a negative theta trade. Buying a call or buying a put is a negative theta trade. When you do a long strangle, which is both together, then you are double the negative theta. So that's the downside. But the nice thing about these calendar spreads that you do around earnings is if you have a stock that had really high volatility, the market's expecting a big move, and the stock doesn't make a big move yet, like Tesla, doesn't make a big move yet, then that short strangle expires worthless, and now the gains that you made from the short strangle cover the cost of your long strangle. Right, cover the potential loss right now. You still lose more because of time decay, but it gets you basically to a break-even point now on your long strangle. The stock doesn't have to move. You already kind of are at break-even already, and now you can let it go. Now it can go either way, one way or the other, and you start making money instead of having to wait for it. Okay. So for an example, let me show you really quick on the risk profile. If I did a long strangle right now, on Tesla. How come I'm not getting any numbers here? I didn't do it, did it? I don't want deal price. I want... Well, I'm not getting any numbers on any of these, am I? That stinks. Let me try on my platform over here. Nice. Something's going on with the platforms today. Not getting any prices here. So let's try to ballpark where we would be on this. So let's say we bought a, and go a little bit further out. Let's say we bought a, well, I've got it up here. 275 at 275, 320. And let me reset parameters. Sorry, reset parameters. And set this date to today. And why is it showing me a loss way down here? Yeah, all the pricing is all messed up right now because that's not the case. This is not the case right now. Let's see here, $3,500. Yeah, this is showing these options as worthless, and these options are not worthless. 1850, 1690, 1745, and 1285. So I don't know why these are showing up as worthless right now. Yeah, this is kind of strange. I don't know why I'm not getting these pricing to show up on either one of these. So regardless, so what the line would look like here, this is really annoying, but what the line would look like is it would look like this, right? That would be what you're more like this. It'd be like your profit loss line would be kind of coming up. That's what the profit loss on today would look like, okay? Typically for a long strangle. So you have a break even over here and a break even over here roughly. And there's the current price of the stock. That's what a typical profit loss would look like on a long strangle. And you can see, you know, our expiration has got to go out even further. Right, there's your break evens on expiration. It's the strike prices of your long strikes, you know, plus how much you paid for them. That's where your break evens are, way out there. Because see, 320 is my strike price. There's that the call strike price. So my break even's way out there because of the cost. Okay, what is it? 275 is the strike price here, but my break even's way out here because of the cost of both of these options. That's where my break even's way out there. But my break even today is going to be the purple line usually, if it's not showing these options as worthless right now. The purple line, which is what I've drawn, this red line, that is what your P&L today would look like. And so what that short strangle did is it raised up your P&L to up above 0. So now my break-evens for today, there isn't any because you've locked in gains for today. Now the stock can go either way, one way or the other, and you start making money. Now eventually time decay will bring that line down. So you need the stock to make a move. But that's the beauty of strangle, of these calendar spreads on earnings. When they work out, when the price stays within the range, when the price stays within the range, let's go back to the chart here. Nope, this one. Then when the stock stays within the range, but still you expect a breakout, I'm still expecting a breakout here. on the stock, one or the other, now I can make money either way. I don't care which way it goes. I can make money on it. Okay. No, it's a strangle. Ashton, the strangle is when the strike prices are different. The strangle is when the strike prices are different. A straddle is when the strike prices are the same. Strangles are when strike prices are different. Same expiration, Curdy. Strangles are when you buy or sell different strikes. It has to be a call and a put, right? It can't be two calls, it can't be two puts. It has to be a call and a put. When you sell both at the same time, a call and a put, but at different strikes, that is a strangle. When you sell a call and a put at the same strike price, that is a straddle. Yeah, and the earnings, so the earnings, yeah, has to be a different expiration. Yep. But see, the calendar earnings, Curdy, is two strangles, right? It's a short strangle in one expiration. It's a long strangle in the other expiration. And the benefit of looking at it separately like that is if your short strangle works out, if your short strangle expires completely worthless, it gives you the ability to hold on to the long strangle. Right? If your short strangle expires worthless, it gives you the ability to hold on to that long strangle to see if the stock does indeed make a big move. And now you just add to your gains. Yes, the strikes are the strikes are the same. That's what makes that calendar, right? Otherwise, it would be a diagonal spread. The strike prices would be the same. Okay. So in the case of Tesla, it dropped. There's a lot of factors that can make that stock go down. You can see the market's always pricing in what's next. The market's always pricing in what's next. And so when you have an earnings announcement that comes out, you typically will get some kind of like knee-jerk reaction on the headline news because the market's pricing in that earnings announcement right here. All this move right here, now it also happened to be, there's a lot more factors that impact the price of a stock. Of course, the broad market was weak. That's what held this down to. A lot of factors can impact the price of a stock. But one of the factors is pricing in that next earnings report, that next quarterly earnings report. And so once the earnings comes out, then the market will react to that number according to their expectations. But that's the knee-jerk reaction. Right? That's the immediate reaction. That's like the headline. If you have a computer program to trade the headlines, you'll see a bunch of trades come through that might be pretty much programmed in based on what the headline says. So you'll get kind of like a knee-jerk reaction to what the market has been pricing in. But then after that, it gets back into pricing in expectations mode again. So now it will dig into those numbers very quickly, mind you, and start pricing in what next quarter is going to be. How things are going to look going forward. And you can see, look at the earnings, just keeps getting progressively more negative here on the stock. So that's why you'll see, sometimes the stock might beat their estimates, but the stock will tank. Because, what matters now is, what about next quarter's estimates and the next year's worth of estimates? That's what the market cares about the most. They don't care about what's happened in the past. They care about what's going to happen in the future. The stock market is always about pricing in what's coming up, right? It's all about pricing in what's coming up. It does not care about what's happened in the past, only to the extent of support and resistance levels and things like that, right? It's all about what's going to happen in the future. That's why the markets have been so bullish. These stock market has been so bullish here because as soon as the new administration got elected, it was about, okay, what are they going to do? And there was a lot of expectations for new fiscal policies that would be very pro-markets. And that's why the markets kind of took off. And then over here, when you got all this fluff, this was all tax reform related. So you had this kind of push higher on the premise that we'd get a passing of the tax reform bill. And then you did get the passing of the tax reform bill, so you had a little bit of a sell the news. And then once the new calendar year came in, it was like, okay, this is really going to make a huge difference, and stocks really took off, right? So that was all tax reform expectation-related news. And so now I kind of think the market's kind of forgot about that, because the market doesn't care about what happened in the past. It cares about what happens in the future. And one of the fundamental reasons why I think stocks are going to go higher, because now that the tax reform has passed, and now as the effects of it, as the companies start actually making decisions off of it, and start pushing through those decisions and getting a return on investment for those decisions, you'll see positive benefits that will be positive to the bottom lines of these big corporations, which was mainly what that tax reform was for, and that will be positive for the stock market. Because again, the stock market is based off of earnings and economics, earnings in the economy. Okay. All right, so that answers a couple of questions there. Should answer. Marcia, let me know if you have any follow-ups there, and then of course I also got the calendar spread. So if you have, so we talked about the calendar spread if you don't have a position. If you do have a position, a calendar spread on a stock that you own, you would just sell an out-of-the-money put. You would buy an out-of-the-money put, and that's further out in time, and you would finance some of that put's cost by selling a really expensive put at the same strike right now. Right, that's what a calendar spread would do. So you'd look out of the money like 20 delta, 30 delta. So for example, if you're looking at Tesla back on that analyze, no, it's not going to let me do it, but let's see if this has it. This has the numbers. It does. So if I were looking at Tesla on the day, let's say I own Tesla. I probably wouldn't have because it's in a downward trend, but let's say you did. You would go out further in time where the options aren't so expensive, because you can see that number 55 for July. It only dropped to 53. So you want to go, further out in time to buy the protection. So you go out to say, 270 here, 275, and you buy that option for 18 bucks. Now, you can finance some of that. Excuse me. You can finance some of that option trade with selling up here the 275 for 325. Okay, so like I said, it doesn't cost a lot. But if the stock takes off, so now I have a positive 18 delta there, and I have a negative 31 delta there. So if the stock goes up $1, I'll lose 31 bucks here, but I'll make 18 bucks, and up to the point where I can make $325 here. So that means I can lose, roughly, $8 to $10 worth of the stock going up to lose $300 on this option. And then I can just close, if the stock did go up, I can close out my protection after the earnings. So that's how you can do the earn. That's just one. That's just doing one. But I don't like to do just one side on earnings announcements because you just don't know which way the stock is going to go. I prefer to do both sides, to do a call on the one, a put on the one side, and then a call on the other side. Okay, so you do this one over here. And these are a little bit further out. You'd be more likely to come up here and say, okay, where can we go in this range? And you start looking, for that low 20 deltas over here. So I didn't do 277.5 because there isn't one in the back. So you sell, that 275, and you come over here and you sell that 325. And then you buy further out. You buy those same strikes further out to protect. And like I said, if the stock stays in between that, now I've got a long strangle I can hold on to because I've made, what, $6 $600. If the stock stays in between those two strikes after the earnings, then I lock in $600. That's going to cover the current loss, your current P&L on your long strangle. On your long strangle when you buy that strangle. All right. What else we got here? Does anyone have a hold scan? I don't know. Curdy, do you know of? I don't have one. I think Ashton's the one that asked this one. Do we have a scan built in for hold? I don't have one that does that. Is there one? Curdy used to have one. Looking for something that has a close above the high below day. I don't personally, Ashton. I'm sure it can be programmed somehow, and I'm sure someone in the community maybe can put one out there in one of the forums. Just kind of look for that. But I personally don't have one. Yeah, it's hard. I think it's hard to really pinpoint. Yeah, it's hard to kind of pinpoint the specifics, and so a hold. Let me talk about what a hold is. Yeah, James and Ken have it. So I'm a little different in this. Oh, nice, Ed. Ed, if you can share that in the forums, that'd be great. Like in the technical analysis forum, just create a new topic. Today's the last day. Today's the last day for the promotion. So remember, you get your name in the hat if you have, for the random drawings, if you have any new topic created and any reply to a current topic. That'd be great. Thanks, Ed. So a close above the high of the low day. So this is where I've had a little bit of a sticking point with that. A little bit of a sticking point. I differ a little bit. So what constitutes a low day? And in your experience, what constitutes a low day? What do you think? Okay, so we got a couple of answers here. 5 to 7 day low point, lowest red candle, the lowest low in the 5 day, lowest price before the bounce. All right, good, yeah. Those are all things that I would look at too. It's the lowest low point during a pullback, right? Everybody agree with that? The lowest low point during a pullback. Would everybody agree with that element? Lowest low point during a pullback. Yes. The pullback is what makes that scan hard. And in my opinion, the pullback is the sticking point for how a lot of people use that close above the high below day, right? Because how much of a pullback is enough of a pullback? How much of a pullback is enough of a pullback? And so, in my opinion, it's more than just a time frame, right? Because I mean, you could be way up above, like the MACD and stochastics could be very, very, very high, and you can get a close above the high of the low day, and it can bounce. And who knows how long it's going to bounce for, right? Whenever I want to trade a bounce, I want it to bounce for a while. I don't want it to bounce for a few days. I want it to bounce for a while. I don't care if I don't care if the candle is red or green. I just care about the pullback, right, Bruce? So I care about the lowest low point during a pullback. The lowest low point during a pullback. And so I define a pullback as any time your oscillator gets below the midpoint of its chart. And I prefer to have more than just one oscillator so they confirm each other, right? So in this particular case, and it has to come from above, the oscillators have to come from above the midpoint of the chart, okay? So so for example, MACD and stochastic, very common combination to use, right? So I define a pullback here using this set of indicators as any time the MACD, not the histogram, because the histogram measures these two lines here. I care more about the actual MACD itself. So anytime the actual MACD itself gets below 0 and the stochastics gets below 50, that means I've had enough of a pullback that I can use for a buying opportunity. Enough of a pullback that I can use for a buying opportunity. So that's actually a little bit longer than 5 to 7 days, right? 5 to 7 days would be more of a near-term pullback. And that's what I use. I don't even have to use like a close of the high below day. I just use I have to get used to using the right ones here. What I like to use here on the near-term pullbacks is this, the near-term line, right? Because when you're on a bullish trend and the near-term line gets below 50, if you're on a bullish trend, where will the near-term line bottom out? If you're on a bullish trend, where will the near-term line bottom out? Keyword there is bullish trend. Exactly, above, between 20 and 50. So above 20, but below, you have to get below 50 to create a bottom. Okay? So if I'm on a bullish trend, anytime the near-term line gets to 50, I'm looking for a reversal. I'm looking for a near-term reversal. You know, again, one of those 5 to 7 day kind of things, right? I'm looking for that near-term reversal where a near-term bounce could last 7 to 12 days. If we're on a bullish trend, and that would constitute the intermediate line rising up above 50 or in the upper reversal zone, one or the other. Rising up above 50 or in the reversal zone. That's when I start looking for the pullback, the near-term pullbacks. Very, very easy to see, and then you just look for the bounces at that point. In fact, you don't even really need to look for the bounce, right? You don't even need to look for the bounce because you expect it to bounce. That's what it does in a bullish trend. You expect the near-term line as soon as it gets below 50, as long as it doesn't get below 20, you expect the near-term line to bounce. If it doesn't, then you use your stop order and you get out. You know, you get out if it continues to break down. But, you know, especially if the momentum line drops below 20 on that, if the near-term line gets below 50 and the momentum line drops below 20, but just a little bit below 20, then that is like, I don't have to wait for a bounce there. I just make that trade right there. That's a near-term bounce opportunity for me. When the intermediate line is bullish, when the posture is bullish, when it's got a relatively strong bullish posture, so the intermediate line's got to be above, rising up above 50, or doing anything up above 80. Okay. So that's a little bit of a discussion there on the Cahold. I actually like Cahold. I think Cahold is a great way to determine if something is bouncing. I just think that the pullback has got to be a little bit more significant than just measuring it by how many days we've dropped. I think you've got to measure it by the fact that an oscillator or two are below their respective charts midpoints, right? An oscillator or two are below their respective charts midpoints. That's when I know that I have a low day, right? If I'm just getting a pullback, you know, if I'm now go back to a regular chart here, and let's just go back to the regular MACD and stochastics. So if I'm getting a pullback, then like right here, that's not a low day to me. You know, it's 2 days, but that's not a low day to me yet. We can close above that high, but I don't have multiple oscillators below their midpoints, so that wouldn't be a low day for me yet. I need to get both those oscillators below their midpoints for me to say, okay, I've had enough of a pullback to create a low day, and we bounce above that low day, now I can make a trade. All right, so that covers that one. On the forums, trying to upload a file on the forums. You know what? I'm going to have to spend some time on that one, Irene. I'm going to spend, in fact, send an email to support@marketscholars.com and let me dig into that one a little bit more. I'm pretty sure you can. I'm sure that we wanted the capability to have that in there. It's not allowed on there. So I think that we can. I have to look at that. I have to dig into that to see how we can do that. Because we did make, you should be able to put in like media, like pictures and things. Yeah. So let me dig in and see what I can do with that. But send an email, Irene, to support@marketscholars.com so that I have it on my list. I have it on my list. I've got quite the list. Quite the list that I have going on. So I want to make sure I don't lose that one. All right. Can you discuss VA or Apple on that analysis? I talked a little bit about Apple already. Apple's breaking out above resistance. I mean, that's a very good breakout above 180. Now, if we don't hold this breakout, you know, about 180-ish. If we get back down below 180, that's going to be very bearish. That's going to be very bearish because you can kind of see like what happened right here, right? Here's the fake out, and you can see how bearish it was right there. See where my cursor is? That's a fake out. Fake outs are really bearish. Bullish fake, excuse me, bullish, resistance fake outs. Let me put it that way. Resistance fake outs are very bearish. You can see there was a divergence there too, so that made it work. That just added to it. But look how much it sold off once it got back down below that level. But that's really bullish here, and it did, if I remember correctly, it had decent volume on it, didn't it? Does this not have volume on? Don't we have a Market Scholars volume for this? There we go. Yeah, we had 1.5 times the average volume on the breakout. So decent amount of stocks in a sideways trend. 3 green arrows, spike in volume. I mean, we had that a couple of days ago after the earnings. We had the 3 green arrows, spike in volume on a sideways trend, and then today you just have it again on the breakout from the Buffett news. Don't be surprised though if we don't pull back towards 180. I don't think it will be necessarily a fake out. I think we got some decent. See over here, you didn't get a volume, one sign of a fake out. It's not it's not exact. Nothing's 100%, but one sign of a fake out is you don't get the volume with it. But you see that we broke up above resistance pretty sharply with volume. That's a good sign that it's going to hold. But don't be surprised if we don't make what's called a return move. A return move is I mean, look at you've gone from 160 to a low point here of 160.5 roughly to up to 184.25. So you've made almost a 24-point move in a matter of a week. Hey, thanks for coming on, Eva. So that's a big move. That's attracting a lot of buyers. There might not be a lot of buyers. It might be exhausted. The buyers might be exhausted right now, and that's what will create a little bit of a pullback towards 180. And it'll be short term. It might take a day or two. If it gets below 180, then it's a fake out. But if it gets down to 180, then there's an opportunity to buy the dip. Right? That's an opportunity there to buy the dip. That's how I look at Apple. VA is going to look almost exactly like the market, because that's a lot of the weakness here this year has been has been in this particular stock, because a lot of the gains that we've had has been in this stock. So it's going to look just like the market. It's got one green arrow, it doesn't have the other two yet. And low volume on this bounce that we had yesterday. All right. Let's see. How do I identify the start and end of a short-term trend using the market forecast indicator? And then any other ways to identify short-term swing trends? With the market forecast indicator, I use the green line crossing above 50 to identify the beginning of a 1 to 3 month move. Right? Getting above 50 would be the beginning of a 1 to 3 month move. Now, this one only lasted a few days, so take it for what it's worth there. But that's what I would look at. That's how I use this to identify the beginning of a trend. Some other things that help is the near-term line bottoming out here, bottoming out between 20 and 50, and peaking above 80. The momentum line doesn't have to do this, but if the momentum line somewhere at the beginning of the trend spikes above 90, that's a positive development too. So from a short-term perspective, we're coming up off a low point between 20 and 50, which is a divergent low point, and you got a spike higher on the momentum line above 90. That's a good sign. Of course, nothing's 100%, but it's a good sign that this intermediate trend will start a new 1 to 3 month run. Nice. Barry, in the forums, in the technical analysis forums would be a good place to put that. Thanks, I appreciate it. Just create a new topic. Go to that technical analysis forum, create a new topic, and that also gets your name in the hat. So that's what I use on the market forecast to identify the beginnings of a trend. Beginnings of bearish trends are a little different. The bearish trends are just hard. I mean, look, the intermediate line doesn't stay down. The intermediate line can get above 80 for a very, very long time. It can get above 80 and stay above 50 for a very long time. You notice it doesn't get below 20 and stay very long. It just doesn't. And even in the most bearish environments. So that's why bearish trends are a little bit harder using the market forecast. I mean, look at all these times over here that the intermediate line, let me get rid of these colors up there. Now look at all these other times that your intermediate line got significantly. I mean, here it spent, what, 1, 2, 3, 4, 5 days below 20 before getting out. That was a pretty bearish time. Here, during this bearish run, you can see the intermediate line stayed below 20, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days before getting out. And then you have the divergence over here. There was a couple of days below. So it just doesn't get below 50, get below 20. I mean, look at all that. Look at all the period of time it stays above 80, and look at the period of time it stays below 20. Now here, give me a second. Let me do something here really quick. See, it'll let me do this. Oops, no. One more. That's not what I wanted. Sorry, I'm trying to get rid of those lines down there. I just want to show intermediate. So there's market sentiment. Let's see if that does it. Aha. Okay, good. And let me get rid of that momentum line too. Aha, there we go. Good. That's what I want to see. Thanks, Curdy. So let me go out further. Oh, do I have to go out even further? Do I have to go out further? No, I just have to scroll over. All right, so here's the last time that we've been significantly bearish for an extended period of time. That's when you have the intermediate line getting below and staying below 20 for a lot longer, but even then, just a couple weeks. But that's when you can get you know, the intermediate line really staying below. But I mean, that was the most bearish time that we've ever had. That's, you know, that was, and anytime you get peaks on the intermediate line with above 50 but not in the upper reversal zone, that's really bearish too. That is really, really bearish too. So those are signs of a bearish trend when you peak above 50 without getting to the 80 level, and obviously more extended runs below 20. But those are just hard. I mean, we just don't get those. I mean, here's a peak above 50 in the intermediate line, and that's why, you know, it was more bearish. We didn't get above 80. We got back below 50, but look, we're just not getting. We're not staying below 20, so this really isn't that bearish right now. And now we're just kind of stuck here around 50, waiting for a breakout move, one way or the other. And again, I expect it to be to the upside on that one, because again, we're just not bearish. We're just not bearish at all. Okay? All right. So there's that. What are your thoughts on a put spread? Put this on here too from Bruce. What are your thoughts on a put spread on BKNG? And if you were going to put one on, what would it be? There appears to be a fair amount of support below its current price. BKNG. Brooking Holdings. And let's just get to a regular chart on this. BKNG, a little bit further out in time. Okay, so let me make sure that I'm on the right stock. Is this right? Who asked this one? Carl? Is this the stock? We're on the right stock? Okay. So if I were looking at this stock for a bull put spread, I mean, yeah, you've got a, you know, a little bit of an ascending triangle going on here. And highs are coming across at equal levels, slightly higher lows, a little bit of an ascending triangle, of course, which would be a bullish continuation. Hey, thanks for coming on, Irene. It would be a bullish continuation, so you'd expect it to break out of this triangle the same way you got into it. Okay. So you expect it to break out the same way you got in. Let's go to the trade tab, BKNG, and see if it gives me, hey, this gives me prices. How about that? So I don't want to go 76 days out, 41 days. Around that 20 to 50 day window, if you're doing a directional spread like this, closer to 45 would be the ideal number for the month that you want to do. And then you're looking at mid-30s delta range, which for this stock is right here in that 2100 to 2110. Take a look at where that would be here. 2100 is right there. So you don't really have, let's say 2100, and what was the other one? Yeah, 2110 to 2100. You don't really have, you know, the great support level in that area. It would be below these lows that you have here. You know, if you did that right now, you're on a $10 wide spread. You need $2.32 to give you enough credit to justify the entry on this trade. $2.32. That would be the ideal number, because that's a 30% return on risk, right? If you're doing a bull put spread, which if I remember that was the question, wasn't it? Yep, a bull put spread. Yeah, put spread. I assume it said put spread. A bull put spread? Yeah, okay. So that's your 30% return on risk. Now you notice because it's so expensive, you're going to get very wide spreads. So you're really going to have to fiddle around here in this range of where you're going to get filled in to see where the actual price is at. Like I said, 232 is the magic number. So even this much credit's too much. Because remember, the more credit you get, the lower your probability of success is. And with a bull put spread, I care more about probability of success than I do credit. Otherwise, if I cared more about return than I do probability, then I would look at, you know, like a long vertical, a long call vertical, or I'd look at a long call. But with short puts, with these out of the money short verticals, then I care more about probability than I do credit. Excuse me. So I want to get the credit that will give me the highest probability possible, at the right balance, because I want, where's that balance? That balance is where I can get to a point on this trade where my break-even level, let's see, June 16th, current price, okay. So there's where the price of the stock can go in one standard deviation move. There's my break-even way over here. So if I were to get to my break-even right in this area, I'm trying to get at 275 bucks, then you can see that little notch right there is right now or about 188 bucks. So the nice balance is the credit I receive is about the same as what my loss would be here. What my loss is. See, this point right here will usually be below a support. You want it to be below a support level. Hey, thanks, Chad, for putting that in there. So that point where my cursor is, you want it to be below a support level. You want it to be a 1-to-1. So you notice the purple line is intersecting the green line there. What does that mean? The purple line is today's P&L. The green line is P&L at expiration. So at expiration, I'm going to lose the same amount of money as I'd lose today at that price, right? That's what this is telling me. Let me zoom it out a little bit so we can see where it's at. So that price right there, you can see my price on today would be about the same as my loss would be at expiration, roughly. And this is, again, this is a very expensive stock, so there's big ranges here. So that's why you have 198 to 178. There's such big ranges because of how expensive, how wide the spreads are on this. But that number, no matter what day, after I get into this trade, no matter when, I'll know I'll lose about that number on that day. And that number I want to be about the same because I want to manage my losses. I want to manage my losses at a 1-to-1 reward to risk ratio so that I don't take big losses. It's much easier. I have a much higher odds of success because remember how I mentioned this is what we talked about last week, that the odds of getting 3 of these in a row are really, really low, much lower than getting 1 of these. And the odds of getting this one is like 30, in this case, the odds of closing out here are almost 40%. So yeah, the odds of getting to this point are higher, but again, you have to multiply, almost 40% here times 3 times to get the same amount of loss. So it's a 6%. I have a 6% chance of doing that 3 times in a row, which would equate the same loss as waiting and getting all the way to expiration, getting that one. So that's why I like to manage losses at 1-to-1. It doesn't like help with my returns. I've told you before, it doesn't increase your returns. It doesn't increase your probability of success, but it reduces your standard deviation of returns. So your returns don't swing wildly. And I mentioned to you before, it's very, very hard to come back from a max loss on a short vertical spread. If any of you have taken a max loss, if any of you have ever taken a max loss, you can attest to how hard it is to come back from that. Because getting max gains is not easy. It's not easy. I mean, you got a 60% chance of doing it, but again, or 65% chance. But what's the odds of getting 3 in a row? It's 27%. 27% to get 3 in a row. So the odds of making up, just getting back to break even, it's very low in 3 trades. Yeah. So you never want to take maximum losses. If you're going to trade vertical spreads, you have to be willing to take the small losses. That's how you succeed. That's how you succeed in those trades. And so again, that's kind of why, like on a lot of these trades, in our class trades, a lot of these are, and this one actually now I do have to close out because I have, I had a note. I don't know why my note's not showing up now. I had notes on here. That loss, that one actually is what I was, to the point where that's what I was trying to make on that one. So Adobe, which was a bear call spread, and you can see the stock's at 229, so it's above. So now I'm taking out, I'm going to close that trade out on Monday. Okay. All the rest of them, this isn't a this is a long call. That's a long call option. You can see it did actually pretty well on Friday. Disney did, and so it's 2.4%. So that one, but everything else you can see, it's just kind of doing its thing, and you just kind of watch to see when you get. That's why you can either set in an automatic. I don't like to set in automatic because I don't mind going a little bit past that. I just don't want to get whipped out. So I usually just put a note, and I don't know what happened to my notes. I had notes over here of what loss I'm willing to take on these trades. And once I get to that P&L open, then I'll close out that trade. Yeah, but I had them in there. I had these notes in here. You can see I put the notes in there, and for some reason they disappeared on me. So Adobe will be one that will be closed out. You can see the May inventory is still doing very well from our options inventory class. All right. So hopefully does that help, Carl, on BKNG? Go back to BKNG over here. So yeah, 2100. I'd be a little concerned about the 2100 because you don't really have good support, and if you were to put it at 2050, I don't think you're going to get enough credit to justify. I mean, you have to get 232, so you'd have to be up here, and that would be a better short strike price. Right? That would be a better short strike price for you from a support perspective. Because then your break even would be a little bit below that, right? It'd be 232 below that, so you'd have a little bit of room to the downside. And then that's your break even. And then that spot where they, diverge, so 2050. And then is it 2050, 2040? Yeah. So that would be the ideal one right there, if you can get 232 out of it, at least. Probably it's not penny increments, so you're probably going to do like 235 or 240. Yeah, well, yeah, that's the better price at 2050. And you can see, so there's your break even is going to be, your break even is going to be a little bit below 2050, so it's going to be 2050 minus 235, right? So that's where your break even is going to be. And then that notch is going to be a little bit below that, down to 2045. So that gives you a little bit of room to get to break even. So 2045 is going to be right there. So you're going to be right around that support level because of how expensive this is. So I would instead, you have some major resistance at 2200. And we're kind of hoping that it will break through that. So I would instead wait until you get a breakout, and then use that 2200 as and you can see you're getting $5 wides up there. Use that, and as you break through that, of course, for a $5 wide, it's only $1.16. Wait for it to get down to about $1.20 in credit. And now you have a much stronger support level, because that will be, if you break through 2200, that old resistance is going to be a much stronger support level than this will be right here. And this one, 2050, you might not be able to get enough credit right now to justify the risk of the trade. See, the further, and I've mentioned this before, the danger of going out to those really, really low deltas. The danger of going out to the really low deltas on these, so let's say like go out to really, really low, like this 15 delta here. Here's the danger of going way out there. So now I've got $18. That crossover point here, you notice now I'm losing $64, and I'm only trying to make 18. So if that's my exit, I mean that's about a 1 to 3 reward to risk ratio, just to get to that point, right? Just to get to that point there. That's not, that's the danger. And like I said, usually you're gonna, if we pull back, you're gonna think, well, I've got a lot of, I've got a really, really high probability. So as it pulls back, you're not going to do anything because your strike's so far away, and there's just no way it's going to get all the way down there until it does, and then you end up with a $182 loss. And that's practically impossible to come back from. Practically impossible. In fact, you all know the story of Karen the super trader. Right? Some of you or most of you may know the story of Karen the super trader. That was something that that was a big part of what she did. And it works until you take that maximum loss. And I think she was like indicted, or she was charged with malfeasance because she took a maximum loss. I don't know the exact story. I just know that she got in trouble. Her name was out there she got in trouble. So that's the danger. It works great. Yeah, it works great. It's high probability until you take that maximum loss, and then you're toast, right? And then, like I said, the reason why you don't want to take maximum losses is because when you get to that point right there, you don't even want to take a $65 loss, right? For an $18 gain, you're not even willing to take a $65 loss. So you wait, and you hold on, and you hold on, and you wait for it to come back, and to make that measly 18 bucks, you wait for it to come back, and you end up losing way more than you ever wanted to. That's the danger. I mean, shoot, just losing 18 bucks. If you keep your risk reward to, let's say within a week, if you keep your risk reward to 1 to 1, within a week, the stock can go down to right there, 259. And I would lose as much as I was trying to make, 259. 259 in SPY is right there. So basically I have to reverse the last couple of days, and I would lose as much as I was trying to make on that. I mean, that can happen. We were just there yesterday. We were just there on Thursday at 259. Yeah. So you try to avoid that maximum loss, and you do some bad stuff with other people's money. That's what happened to her. Okay. For you, I mean, of course, you're not gonna, it's not illegal for you, but you take a loss like that, and it just blows up your account, and there's nothing you can do, and you've locked in capital now while you're waiting for that expiration date to come. You've locked in that capital. There's nothing you can do with that money. There might be plenty of other great opportunities that you can get into, but you can't because you're locked in and waiting and holding with that capital, begging and pleading that you'll get back up above, that max loss strike price, and you don't, and then you just give up. And then you just give up, which is horrible. It's a horrible thing to do. So just be willing to, that's why I don't like trading the strikes way far out of the money. The balance is where that point right here equals how much you're trying to make. So you get a 1 to 1 reward to risk ratio, and usually that point is right about a 30% return on risk. Usually that point is right about a 30% return on risk. That's why it's so good. That's why it's such a common, the 30, that's why you hear everybody talk about 30 to 40 delta. It's for that very reason. But you have to take that loss. You have to take that loss. Not a lot of people do, and that's why they struggle with vertical spreads, even though it's a high probability strategy. All right, we talked about that one. You've introduced several strategies: Bollinger Bands, DMI, market forecasting regressions. Is there a better time frame to use a particular set, or basically an individual's preference? I like using them on daily charts. Who asked this one? It was Dave. Dave, I like using these indicators on daily charts more often than not. The longer the time frame you get, And it doesn't matter if it's 3-month daily, 6-month daily, 9-month daily, 1-year daily. I mean, as long as it's a daily chart. If you any other time frame is basically just zooming in, right? So a 3-month daily versus a 1-year daily, you basically just zoomed in on the last 3 months. It's the same chart because they're both daily charts, but you zoomed in on the 3 months. That's why I like instead, I prefer instead of using a 3-month, like a 6-month here, I prefer just to go out to the 1 year because I can always zoom in. Right? If you just stay with a 3-month chart, you can't zoom out without changing the time frame. So I just go out to this 1-year chart, and if I want to zoom in closer, I zoom in with that. So there's 6 months. Your first zoom in is 6 months. Your second zoom in will get you to the last 3 months, generally speaking. Okay. Weekly charts, all those indicators work better on a weekly chart. They work even better on a weekly chart. But the problem is they take forever to actually play out, and you don't get very many signals on a weekly chart. So I'm willing to put up with more false signals on the daily chart to be able to get more signals and for those trades to work, for the price to move faster than on a weekly. But on a weekly chart, everything's always, every indicator is always more reliable the bigger the time frame. So if a candle has 5 days in it instead of 1, so a weekly chart versus a daily chart, that time frame, the indicators will be a lot more reliable. You just don't get very many. Monthly charts are even better. You get 30 days worth of data in one candle versus 1 day. So it's even better. But man, you really don't get very many signals on a monthly chart. Okay, so daily charts is usually what I use. So hopefully, Dave, let me know if that answers your question there on that one. Do you have time where you show the loading the think script for clusters in the Market Watch scan tab? So I put that script out here into the forums, and it wasn't into the. Oh, I wanted to mention this form here. If you haven't already, to put your oops, nope, not in there. Sorry, over here. If you haven't already, it is a chat window. Reply to this and let, again, today's the last day to get a reply in, but you can reply down at the bottom of where you're from. And you can look through and see if there's people that are from the same area that you're from. And then you can create a group, right? That's the great thing about it. All right, so let's go to the technical analysis forum. Technical analysis over here. And Barry posted the cold script. There we go. And so did Ed. Great, nice, thanks, guys. So here's my post from yesterday. And so you get this code right here. Copy it. And you come over to your Market Watch tab. Then you come over to this gear in the top right, that gear in the top right, and customize. You come down to one of your custom, so you have a bunch of customs here. So you come down to one of your custom areas, click on that little roll, and somebody correct me if I get something wrong here, because some of you know better than I do how to do this. You click on that roll, pulls this window here, click on the ThinkScript editor, and then paste over what's in there by default, and hit OK. And then now I've got, whoops, excuse me. You have to name it something. So you name it up here. You change the name to something like clusters, and then you hit OK. And then that will create. Then now it will show up in your list as whatever you called it. And it's not locked because that's something that you created. You can change. These are all platform. These are all platform. So you can't change those. Okay. I don't think you have to copy these lines. I don't think you have to copy these lines. No, this is the most important ones right here. But at least, you know, get that. That's what you need. And it's in the technical analysis forum on yesterday's class notes post. Now, don't go unsubscribing to the Market Outlook email because you have that now, right? And, you know, this, for some reason, it only shows you so many custom. So that's why you might get those errors. And usually I don't know why it's not showing me all 500. It should show me all 500, right? As somebody who knows, shouldn't it show me all 500 stocks? Isn't there like a limit? There's like a limit to how many custom expressions. But I didn't think I thought it was more than 500. Like in my other account, in my class account that I do here, I can get all of them, generally speaking. I have before, at least. No, just give them in here. My live account, I get them all. My live account, I get all. So somebody knows. I don't know the answer to why I'm not getting all 500. So the workaround that we've used is to come over here. In the workspace, if you downloaded the workspace, I would assume you also get these watch lists too. Or even if you didn't download the workspace, Brandon's got a separate post that teaches you how to build these sector watch lists. And so you can just go back and forth here. And so I do get them all now. And you click these down arrow buttons to go through all of them. Give it a second to load up. This one's taking a minute. There we go. So there's 3 oversold sectors. And here, you know what? I'm going to do something. I'm going to do something here really quick. Yeah, this computer is supposed to be fast, but I might have a lot of other things going on right now. I'm going to change the code. Now let's come back over here. There we go. That's better. And you just go from one sector to the next. And see if there's any. So you can see there's not any in materials. There isn't any in real estate. And you got 1 in staples. Tap. But a lot of these have been getting. If you have been getting my daily Market Outlook emails, a lot of the staples have all week long have been getting clusters. So there's a lot of opportunities in this area for clusters of clusters. All right, so check out the staples for that. Okay, and I think that gets us through everything that I could see, unless I missed something. Ashton had a script for scanning cup and handle from the IBD. I don't know. I don't have one for cup and handle. Somebody else might be able to come up with one. I would think if hold is hard to run a script for, to define that low day, the pullback, to define the pullback that produces a quote-unquote low day, I would imagine it's probably a little difficult to define a cup and handle. All right. Sunita, if one is trading, so here, let me pull this over. If one is trading, shorting the put to get stock way out, is it necessary to buy also the put rather than just play naked put and not do the spread? Do you feel like one should do that or not as a trader and not as a teacher? Well, I'm a trader and a teacher, Sunita. You get both in one. So I'm teaching you how to trade, right? There's no difference. There's no difference in me from being a trader or a teacher because I'm teaching you to trade. I'm teaching you what I do and how I do it and why I do it. That's the whole point of this. I didn't see your question, Shirley. I'm sorry. I didn't see your question there. Ah, there it is. Let me pop that up in there. Thanks for pointing that out. We'll get to Sunita's question here in just a second. When you look for trades, what time frame do you use? So that's similar answer to over here. You know, again, so if you're talking about the charts, I use the daily chart. If you're talking about like how long the trades last, that kind of time frame, it depends on the trade, right? The trending trades can last multiple months or a few days if I hit my stop order quickly. But the point of trending trade is to last multiple months. I want a trend trade to trend as long as possible because that's how you make the most amount of money on a trend trade, right? As long as possible. If I'm selling premium, if I'm doing short, if I'm selling options, selling premium, then I'm looking for that 45-day window. That 45 days out, you know, 20 to 50. If I'm building an inventory, I'm willing to go down to 20 to make trades in my inventory. If I'm doing individual directional trades, Shirley, like a short put all by itself, just on the stock all by itself, then I'm looking at that 45-day window as close as I can for that. Okay. If I'm doing a long call, long put, then I'm kind of looking for similar, kind of like a 6 to 8 week. I mean, that's the ideal scenario because you want to go out and far enough in times, which you end up going past 50 days to buy a call option or a put option. You go outside there to avoid time decay. And then, generally speaking, you'll probably end up getting out of the trade when the stock hits its target about, you know, a few weeks before the trade. So you're talking long calls, long puts, swing trades. You might be in there for, you know, 6 to 8 weeks in that time, or get, you know, if it works, right? You get, if it's not working, then you get out. If it's not working at the halfway point, then you just get out and you take whatever small loss, small gain you have and get out if you haven't been stopped out yet. All right. So coming back here again, like I mentioned before, so I will never tell you something as a teacher and not a trader, right? I will always teach you from a trader's perspective. So everything I always talk about will be both. That's why we do what we do here. Yeah, on a short premium, Carl, on a short premium, yes, closing out at 50% of profit. If you don't have to pay the commissions. If you have to pay the commissions, then I go out to that 80% of profit. Then I go out to 80% of profit on short premium trades. Unless it's an inventory trade, and I go out to the 5 cents. All right, thanks, Lawrence. Great to hear that. All right, so in terms of shorting, if shorting put to get the stock, I usually don't do put vertical spreads to get the stock, right? Usually I will just get the call, short the put, sell the put, and that's it. Because if you get put the stock, you end up with this long put that you didn't need, right? You know, you're protecting, the long put on the vertical spread is for protection. You're not really necessarily needing the protection because you're going to buy the stock when it goes down. So no, I don't necessarily use a put vertical spread to buy stock, just selling a put. Just selling a put. Remember, though, that the strike price better be at the price that you're willing to buy the stock at, right? If you sell a put, which is usually out of the money, down below the current level of the stock, so for example, if I was wanting to buy SPY right now and I wanted to sell a put on SPY, and I go out to this 41 delta, a 41 time, and I come down here, man, I don't want all. It's taking me forever to scroll. All right, so if I were to come out to like, the 260 delta here, 31 delta, excuse me, and sell the 260 for 285. Now it's going to take me $4,700 to get that $284 minus the commissions of this trade. But I better be willing to buy this stock at 260. Would I be willing to buy SPY at 260? Probably, because it's still there above support. But if I put a put at 255, I don't think I would be willing to buy it at 255. I don't think I would be willing to buy at 255 right now, because I'd be breaking pretty significant support. I'd be worried about it continuing to go down. So at 260, yes, I think I'd be willing to buy the stock at 260 if we were to pull back, but still hold support level there. See the difference? That would be the difference there. And when would I buy it at 260? Well, if we close expiration like at 258, 259, I'd end up buying it at 260. And that would be fine because I'm getting paid right now $2.85 to buy it at 260. My break even's 260 minus 285. So if I get anywhere, a dollar or two around 260, and if the stock were to get to 258 and I end up buying at 260, I still made 85 cents on the deal. I lost $2 from buying it at a higher price, but I still made 85 cents. All right. Well, that gets us to our questions, and at the 2-hour mark, so that's not too bad. Not too bad for a Saturday morning. As always, thanks to everyone for coming on today and for your questions and your topics of discussions. I've really liked our session so far. I've never had to fill time with you all, because you all bring on good topics to discuss that I think are very relevant and very helpful for the broader audience. So thank you very much for sharing. I know sometimes it's like, well, what do I ask? I don't know what to ask. I don't ask a dumb question, and I'm glad. I hope that's not the case for anybody out there, because every time we talk about anything, I feel like it's very, very good topics for everybody. So thank you all every week for coming on and for sharing your ideas and your questions and your topics of discussion with us. Have a great rest of your weekend, everybody. Remember, Brandon's out tomorrow or Monday. So no class for Brandon on Monday or Tuesday, and then I'll be back regularly scheduled class on Tuesday evening with our directional option strategy. So again, have a great weekend. We'll catch everybody in our next class. All right, goodbye, everybody.